Alright guys, welcome to my home buying guide for first time home buyers. My name is Anthony Fata and I'm a licensed mortgage agent at Owl Mortgage. Getting into the housing market in Ontario can be complex at times, but buying your first home tends to be even more complicated. You've no doubt got hundreds of questions. These can range from should I go with a fixed rate or even a variable rate, how to save for a down payment, whom to trust with my mortgage, or even what rebates you might be eligible for as a first time home buyer. Within this step-by-step guide, I'm going to go over everything you need to know so you feel equipped moving forward with the home buying process. It doesn't matter the property type. It could be a condo, semi-detached, townhome, or even a detached home. By the end of this presentation, you'll understand the home buying process much, much better. Step 1. Get pre-approved. Before starting any sort of house hunt, it is crucial to know what you qualify for. I want to emphasize the difference between getting pre-qualified and pre-approved. As you can see on the left side of the slide, a pre-qualification includes an estimated amount of what you can qualify for. It does not include full documentation submission and the process of pulling credit to see if there are any debts on the file. I like to think about the pre-qualification process as the following. You get the initial thoughts of buying a property, and we should know from the initial thoughts of buying a property to actually buying one, the stats show it's approximately 1 to 2 years. Therefore, it's a long drawn-out process. So people start to educate themselves online, maybe stumble upon a bank website that entices them to input a few general answers about their financial situation, and from there, they'll give you a gist of what you can qualify for. I'll give you an example. I worked with a young couple not too long ago who received a pre-qualification from a bank in the amount of $680K to $700K. They then proceeded to contact a realtor to start looking for homes. It just so happens that this realtor is a referral partner of mine, and I'm not sure how it came up in conversation, but basically he figured out that they didn't have a full-on pre-approval letter. Once he heard this, he referred these individuals over to me. I then proceeded to provide a pre-approval, and the amount came in at $640,000. Some people will see this as a negative because the bank technically gave them more purchasing power. However, this could have gone incredibly wrong. I want to list a few reasons as to why. They could have started submitting offers on homes that they could not afford. Secondly, it wastes not only their time but the realtor's time, and we should note that 99% of realtors won't work with you unless they know what you can afford through a pre-approval letter. And lastly, it's discouraging. This couple started to like some properties within that price range, so it was tough for them to adjust afterwards. Nonetheless, a pre-approval provides a definitive answer on how much you can qualify for. For myself, I do not deal in pre-qualifications. I only provide pre-approvals. There's no room for error on our part when it comes to advising clients on how much they can qualify for. So I require all documents up front with a credit pull to see if there's any debts on the file. Once that is done, I not only provide a pre-approval letter from a bank that offers a great rate with a rate hold of approximately 90 to 120 days, but also some other options alongside it. This is simply because the lowest rate isn't always the best route. There are terms and conditions within your mortgage contract that you sign that have significant weight on the mortgage product you choose, such as prepayment privileges or penalties when breaking a mortgage contract early. I try to make it a goal of mine to remind clients on every single call that there is more to a mortgage contract than a great rate. Pre-approval components and the process of obtaining one. We'll go into each detail of each bullet point in the following slides, but before I get started, I want to explain how I provide pre-approvals. I always try to hop on a quick call with a potential client or clients just to get a gist of the situation, and basically I use these components to go off of to make sure there is no time wasted. If the individuals are nowhere near the home buying process, then I try to establish that right off the hop for the sake of both parties, and I'll follow up in months to come. Nonetheless, whether it be through myself, another licensed agent, or even the bank, you will have to submit several different types of docs to obtain a pre-approval letter. It could be income docs such as T4s or pay stubs, documents verifying your savings through, it could be bank statements or investment statements like RSPs and TFSAs, and sign off on us pulling credit to see what debts are on file and your credit score. I then send an online application link to get some of that info on file. The online application link literally takes minutes to fill out. The link also obtains a signature for myself and my brokerage to not only confidentially hold all your documents once they are submitted, but also a signed signature for us to pull credit. Once that is complete, I send off an encrypted email outlining which documents specifically I will need to get the pre-approval process started. Income docs. What documents might be required for you to submit? If you are salary or hourly, you'll be submitting a most recent pay stub and an employment letter, which could be obtained through HR or your boss, and a 2-year history of your T4s. A T4 is just a slip produced by the company that you work for and reveals how much you've earned over the last year. Over on the self-employed side, we'll be looking for also 2 years history of your T1 generals. Basically, this is just a document that captures everything from your total income to your net income to your taxable income and lets you know whether you'll have a balance owing or a refund coming in the mail. If you can't find this document, you can easily just reach out to your accountant and they'll get it over to you. An NOA is very similar to your T1s. Essentially, it's just a post-filing summary. Your master business license or articles of incorporation. This is essentially just registration of your business, of you being self-employed. Your business bank statements are a summary of all your business transactions, what's going in and out of your business account, and your business financials. They demonstrate the company's performance, so revenue, assets, and liabilities. And on this page, we should note that some of these documents request a 2-year history. This is simply because the banks love stability. They want to verify your income and make sure it's not only predictable, but reliable when underwriting your loan. Down payment sizes. A conventional mortgage is a down payment equal to or greater than 20%. So literally anything over 20% down is a conventional mortgage. Typically, people want to put down as much as they can if they want a lower monthly mortgage payment as well as paying less interest over time. Whereas an insured mortgage, also known as a high ratio mortgage, is anything less than 20% down. There are some intricate details to know about the insured mortgage, so we'll go over that. Just because it's anything less than 20% down doesn't mean we can get 100% financing from the bank. That's only possible in books that you read or advertising for clickbait. The minimum amount you can put down on a property in Canada is 5%. However, it's 5% on the first $500,000 and an additional 10% up to $1 million. And we should note, high ratio mortgages only go up to $1 million. For example, the down payment math on a $600,000 property would be the following: $25,000 for the first $500,000 and $10,000 for the remaining $100K for a total down payment of $35,000. High ratio mortgages are insured by companies such as CMHC, Sagen, and Canada Guarantee. Since these mortgages are insured, they come with a lower interest rate than a conventional mortgage. This is what you see advertised all the time on social media and radios. It's essentially clickbait and once again only applies to mortgages or individuals who put less than 20% down. The stipulation with that though is you pay a premium called default mortgage insurance, which is added to your mortgage amount. If one's goal is to just get into the market, then this is a great option, especially if you don't have several years of savings under your belt. This is an example slide for down payments. Down payment sizes vary on every single application. No two applications are the same, so I figured it's best to provide a quick breakdown of different down payment sizes and what an individual can expect to pay when it comes to default mortgage insurance that is tacked onto the mortgage amount. So I put the purchase price at $600,000, and just for the sake of it, I'll use the 10% down scenario. You've got $600,000 property minus 60 grand, which is $540K. But since you're putting less than 20% down, you'll need to pay the insurance premium. As you can see, the estimated insurance cost will be approximately $16,740. And when you tack that onto the mortgage, it'll be approximately $556,740. The following table provides you with a general idea of the premiums charged by default mortgage insurance companies. As you can see, it ranges from 2.4% to 4% of the mortgage amount. As I said before, banks and lenders are able to offer lower mortgage rates when mortgages are protected by this default insurance. You can expect to pay anywhere between 0.20 to 0.30 basis points lower than a conventional mortgage when it comes to rates, which can be considered to offset the cost of the premium that is added onto your mortgage amount. So you might be winning on the interest rate side of things, but it is tacked onto your mortgage amount, which you end up paying interest on. The banks win no matter what. However, this is a good entrance or option of getting into the market if you don't have years of savings under your belt, like I said. As you can see here, the more you put down, the less you pay in premium, and the less you put down, the more you pay in premium for the insurance cost. Components of credit score. As I mentioned throughout the presentation, in order to get an accurate number of what you can afford, credit must be pulled so we can not only see what your credit score comes in as, but also the debts you hold. I figured it would be wise to go over how both TransUnion and Equifax judge your credit score based on the factors above. By the way, both of these companies allow for a free credit pull to see what your credit score is. As you can see in the pie chart, payment history is number one. It literally means pay on time. I bank with RBC and they have an option to set up auto payments so my credit card is always paid off monthly, just in case I forget. I suggest that anybody watching this video to do the same. The second largest component in which they judge is amounts owed. I like to explain this as the credit utilization rate. Banks do not want you to utilize more than 30% of the available credit to you. For instance, if you have a credit limit of $1,000 on your credit card, they do not want you owing more than $300. So I always encourage individuals who are responsible enough with credit to take the credit increase that you receive from your bank just so you aren't utilizing more than 30% all the time. Just for argument's sake, if you have a $10,000 credit limit on your card compared to the $1,000, you can utilize $3,000 without being dinged, instead of always worrying about going over the $300 utilization rate on your card, right? So with regards to the last three, it's fairly straightforward. Length of credit is essentially how long they've been documenting your credit history. Anything less than 2 years is considered a little too short for lenders to judge on. But once you're beyond that point, they get a better understanding of how you pay your debts. As for new credit, they literally just don't want you opening up a bunch of different credit accounts and then closing them. Lastly, credit mix. It's exactly how it sounds. They're looking at how you manage different types of credit over time. So how you manage your line of credit, your credit cards, and your mortgages, etc. Right? In this slide, I thought I'd provide a pre-approval example that I recently provided a client. The lender in which you can see at the top left is First National. This lender is only accessible through the broker channel, meaning you need an agent to access it. Not only do these sorts of banks compete on rate with the big banks, the big five banks like Scotia, TD, and RBC, and so on, they usually come with much more favorable mortgage terms and conditions. As I mentioned earlier in the presentation, I like to provide a few mortgage options and solutions when providing a pre-approval. So I'll usually find the best rate on the market from one of our big five banks and then provide a few alternative lenders if they are competitive with the rates. And from there, let the client make the decision as to which bank they would like to proceed with. Some individuals will stick with the big five banks even if an alt lender shares the same rates and has better terms and conditions due to just being familiar with that bank and already probably banking with that lender, right? Whereas some clients really dive into the mortgage contract to make sure they get the most out of what they're signing. Nonetheless, there are a few other components I can speak on in this pre-approval letter. The rate hold, which is held for 120 days, as you can see. Rates are always fluctuating. If rates had higher, you're locked into that rate, so there's no need to worry. However, if rates had lower, it's my job to go back to the bank again and request a lower rate to be held for yourself before you close on a property. The terms taken on in Canada are usually 1 through 5, with 5 being the most common. After your term expires, you will receive a renewal letter in the mail. When this occurs, you either sign on the dotted line or shop around with your agent to see if there's a better rate being offered in the marketplace between banks. With regards to terms, you can also have an open or a closed term. An open mortgage is one with flexible options to increase your mortgage repayments, either by increasing your regular payments or through a lump sum. A closed mortgage, on the other hand, will penalize you for paying off all or part of your mortgage early. While prepayment penalties can be significant, closed mortgages also come with a much lower interest rate than open mortgages. So like I said, the fine details within a contract matter and are specific to each individual and their goals in the coming years. The amortization is essentially how much time it'll take to pay off your mortgage in full. Most individuals nowadays take on the 30-year AM simply because it comes with a lower monthly mortgage payment and you get more purchasing power out of it, meaning you qualify for more. However, that does add up to paying more interest over time. The 25-year AM is taken on for 2 reasons: paying off your mortgage quicker and less interest paid over time. Lastly, the rate type. Fixed rate is the set it and forget it mentality. The rate and payment do not fluctuate monthly, whereas there's the variable rate that has 2 types, and I kind of want to go over this quickly. There's an adjustable rate, which the actual dollar figure monthly changes as the Bank of Canada overnight rate changes. If the Bank of Canada increases rates, your payments go up. For example, if your monthly payment was at $2,000 and the BOC hikes, your next monthly billing, you may see $2,100 per month, and vice versa if they decrease rates. This product is available at Scotiabank. The static variable payment is when your monthly payment does not increase or decrease. Rather, the portion of the payment towards interest and principal fluctuates. For example, you may have a $2,000 monthly mortgage payment. Of that, 80% might go towards interest and the other 20% might go towards principal. If the Bank of Canada increases the overnight lending rate, your interest costs within that 2K payment will increase. So instead of 80% going towards interest, it might be 85% now, and paying down your principal by only 15%. The same could be said for when they decrease. You would be paying more principal down, which in turn establishes more equity within your property. Debt service ratios, GDS and TDS. This is essentially how banks test borrowers' ability to pay back their mortgage loans. So what is GDS? It's the gross debt service ratio in Canada that refers to the portion of pre-tax income you would spend to service your household debts. That includes things such as mortgage payments, property taxes, heating, and 50% of your condo maintenance fees. As for TDS, it's the exact same thing, but all other revolving debts such as student or car loans, child and spousal support, credit cards and line of credits, anything that is a revolving debt affects your TDS. Here's an example of GDS and TDS calculations. The example is based off of a $600,000 condo with 20% down, so $120,000 on a 5% interest rate, a 5-year term, and a 25-year AM. Dual income, meaning 2 individuals on the application. I put in a simple $500 credit card payment, as well as 2 car loans for a total of $900. You can see these do not exceed the ratios above, and that's kind of how the banks look at how much you can afford and how much they're willing to lend you loan amount wise. So why use a mortgage agent? First and foremost, we specialize in mortgages only. At the bank, you deal with individuals who are trained in multiple departments, which usually equates to a subpar experience. We make it easy and support you along the entire way. I like to let people know we only get paid when the mortgage is advanced to you guys. So when you close on the property and you're an official homeowner, meaning it's in our best interest to give you the best possible experience and mortgage product, as it's our sole commission, which is paid by the banks. You do not pay us a cent, the bank does. Lastly, one of our biggest selling points is knowledge of multiple lenders and accessing all the different products they have to offer and comparing them to make sure you get the best mortgage product for your situation. First-time homebuyer incentives. This is a very important slide, as many first-time homebuyers have multiple questions about these programs. So, first one, home buyers plan, RSPs. Each person can withdraw up to 35 grand. You have 15 years to repay this entire loan, whatever you've taken out to purchase your property, and the repayment starts within 2 years. There's the new First Home Savings Account, FHSA, very similar to RSPs. You have a contribution limit of $8,000 per year, up to 40 grand. It can be deducted from your annual income, and the only difference between this and the RSPs is that you do not have to pay back into this account. There's also the land transfer tax rebate, a rebate up to 4 grand. Toronto has the provincial and the municipal rebate, so you can get a little more back. For an exact quote, I would contact a lawyer. That's their department. However, we can provide a pretty close estimate through our calculators that we have. There's also the tax credit. You can claim up to $1,500 on your personal income tax. As for that, I would speak to your accountant. And lastly, there's the shared equity program for first-time homebuyers. It's a shared equity program with the Government of Canada. 5% on it's up to 5% on resale properties and 5 to 10% on pre-construction units. That they'll come in on a shared equity program to help you with your down payment, which, like I've said before, the more you put down, the smaller monthly mortgage payment you'll have and the less interest you'll pay over time. There's another incentive, but it's not specific to first-time homebuyers. It's the GST HST New Housing Rebate. It offers money back to Canadians who buy a newly built home, substantially renovate an existing home, or rebuild a home that was destroyed due to a fire. In all 3 cases, an individual will incur GST HST on their purchase. And like I said, this isn't exclusive to first-time homebuyers. It's for any Canadian that is eligible. Moving on to step 2, which is a little more exciting. Buying a home or a condo will likely be the biggest purchase you ever make, but don't worry, you don't need to do it alone. Your team will include a realtor and a lawyer. Your realtor's job as the buying agent is to get you from point A, which is a would-be buyer, to point B, a happy homeowner. More specifically, it's their job to educate you on location, neighborhoods that you're looking in, perform due diligence on the property and surrounding properties such as comparables that recently sold, negotiate the contract price and terms when submitting an offer, and so on. As for your lawyer, it is their job to protect your rights by making sure all terms and conditions of your purchase and sale agreement are complied with and that you obtain clear title of the property you are purchasing. If you're buying a condo, your lawyer will review something called a status certificate. A status certificate is a report prepared by your condo court, which gives an important look at the current affairs of the condo. It's very important to have a status review. It sets out the corporation's budget, common expenses, ongoing legal proceedings, insurance status, upcoming major repairs or maintenance issues, and most importantly, the corporation's reserve funds. Nonetheless, your lawyer comes into play more so towards the end of the deal when you're closing, whereas a realtor is alongside you for the entire buying process, start to finish. Step 3, the house hunt. Knowing what you need and want in your home is critical. What are your must-haves, your nice-to-haves, and your no-way absolute nots? This is something you need to discuss with either yourself, your partner, your parents, whomever is going on title. As for location, as the saying goes, location is the #1 rule in real estate, though it is most often overlooked. There are many examples of identical homes being valued differently based on location. So location is very important, and that's why you always hear location, location, location. Step 4, make an offer. We're at the point in which your house hunting efforts have paid off, which is making an offer since you found the right home for you. It satisfies your wants, your needs, it's in your price range, and it feels right. The offer process is both exciting and nerve-wracking, especially for first-time homebuyers. In Ontario, your offer must be in writing and will form the Agreement of Purchase and Sale, APS for short form. The APS is a legally binding document which contains the following on the slide: the price you are prepared to pay, the deposit, which is typically 5% of the purchase price and is due within 24 hours, the closing date, which is the date you take possession, any inclusions, will you get the appliances, furniture, fixtures, and so on. As for conditions, very important, which I'm going to go over a few right now. The condition of financing is a clause in which your offer gives you a certain period of time, usually 5 days, to confirm you're able to get a mortgage approval from the bank. The home inspection allows you to gain more knowledge about the home and helps you avoid any nasty surprises in the future. I briefly went over the status certificate when we spoke about picking your team and the lawyer's job, essentially just checking the condo corp's reserve funds. Sale of property condition, this isn't necessarily for first-time home buyers, but it's when a buyer makes an offer to buy a home conditional on them selling their existing property. Repairs, if the home needs any repairs, you can make the offer conditional on the seller completing those repairs. As for tenants, it's a very important one when buying a property with tenants in there. Make sure you have a conditional offer with this clause included, as I've heard nightmare stories of tenants not leaving. As for the no condition offer, this is known as a clean or firm offer. It can make your bid a lot more attractive to sellers. However, it also means that you're swimming free and unprotected. If something goes wrong, all of a sudden, you may find that you're unable to obtain financing from the bank. This results in potentially losing your full deposit and more. Step 5, closing the deal. So, what's included in the mortgage commitment letter when you're signing? There's the loan amount, so the amount of money the lender is willing to lend you, the interest rate, which we all know, it's the interest that you'll be charged on your mortgage loan. APR includes your interest rate and some other fees like closing costs and broker fees, and it's all grouped into one. Your mortgage term, this is the length of time that you'll have to repay the loan. We've already spoken about that. The amortization period we've also already spoken about, but it's the length of time in which you pay off your entire loan. The payment frequency, this is how often you'll make your payments. That could be weekly, bi-weekly, monthly. The next two are very important. Your prepayment privileges. This outlines any options you have for paying off your mortgage early. It could be through a lump sum or increasing your regular payments. Prepayment charges, when paying more than your mortgage contract allows for, you'll be paying the higher of the following two. So you'll either pay 3 months interest or something called interest rate differential. Basically, this is the difference between the principal amount that you owe currently of the prepayment charge and the principal amount you would be owing using a similar mortgage rate at the current moment when you break it. This can be a hefty penalty and is usually found when breaking the mortgage contract right outwards on a fixed rate product. Closing date is the date you take possession, and conditions, which we've already kind of gone over, outlines any conditions you need to meet before the lender will fund the mortgages. Lastly, closing costs. There's things such as legal fees, which could be approximately $1,000 to $1,500. Title insurance, that's around $300. Home inspection, $300 to $500. The appraisal, we ordered this for you, which is around $300 to $500. I should add in that the home inspection you guys ordered, whereas the appraisal we order it. The bank that you're working with or obtaining the mortgage loan from, they have a list of professional appraisers that they work with specifically. If you have any moving costs, you'll have to buy a truck, maybe $1,000. The status certificate, when you have a lawyer review, it's $100 to $300. Land transfer taxes, I mentioned in the presentation earlier. We can get an estimated amount of this, but that's off of your purchase price. And more importantly, your lawyer can give you the exact price. Statement of adjustments, you may be responsible for reimbursing the seller for any prepaid expenses that they've already done. This could be property taxes or utilities. These costs are typically adjusted right at closing date. You will need property insurance to cover the replacement cost of your home and its contents in it in case of loss. It's also a good idea to get mortgage life insurance, which will protect your family if you pass away before your mortgage is paid off. We are legally obligated as brokers to provide life insurance, which is presented in the mortgage commitment. You have the option to opt out, of course. If individuals opt out, I usually provide an insurance broker to contact to see if there's any more flexible options that fit you better. As for mortgage-related costs, interest adjustment amount is one of them. If you have a closing date on May 26th, let's say, and the first mortgage payment does not leave your account until June 1st, you'll have to pay interest between those two dates, and the bank will literally just take it right out of your account when you pay your mortgage payment. Or there's stuff such as the default mortgage insurance when putting less than 20% down, and as mentioned earlier, it's added to your mortgage amount. And lastly, to recap everything and kind of swing it all together, step 1, we went over getting pre-approved over the pre-qualification. Step 2 was pick your team, your lawyer, and your realtor. Step 3 was the actual house hunt, knowing what you want and knowing what your needs are and your location. Step 4 was make an offer. Closing the deal was step 5. And lastly, the last step is it's time to move in. You're a homeowner now. The overall goal of this presentation was to make sure you feel more comfortable going through your home buying process as a first-time home buyer. Whether you are currently looking at this moment or preparing to do so in the future, this guide was essentially made to make the process as simple as possible for you. Lastly, I want to thank you for watching the entire video. I know it's a lot to get through, so thank you for sticking it out. In terms of getting started with the pre-approval process and buying a property, you can contact me at 289-231-3152 or email me at anthony@owlmortgage.ca.